Debt Market Update, March 2021. FY21 was an eventful year for Indian fixed income markets. Indian fixed income yields, which were trending down pre-COVID-19, fell significantly during the year, driven by aggressive monetary easing and infusion of liquidity by global central banks, ample domestic liquidity, domestic monetary stimulus including rate cuts, unconventional tools like LTROs, TLTROs, Operation Twist, etc. employed by RBI, decline in growth, volatility in credit markets, etc. This resulted in 10-year G-Sec yield falling and trading within a narrow range during the first 9 months of the year. However, driven by higher than anticipated rise in fiscal deficits in FY21 and FY22, led to yield rising in Q4 FY21 and ended the year at 6.17%, up 3 basis points compared to last year end. However, the yields at the short end fell substantially, and 3M T-bill yield ended the year at 3.27%, down approximately 100 basis points from the last year. This resulted in yield curve steepening and term premium rising to approximately 2.9% as compared to 1.9% a year ago. Average interbank liquidity was significantly positive during the year, supported by large liquidity infusion by RBI through LTROs, TLTROs, open market purchases, foreign exchange purchases, etc. Further, rise in government spending and soft credit growth vis-à-vis the deposit growth also added to interbank liquidity. This was partially offset by rise in currency in circulation, which jumped approximately 17% year-on-year. FPI flows to Indian debt markets in FY21 were weak, albeit better than previous year. FPIs recorded net outflows of approximately $2.2 billion as against net outflows of $5.4 billion last year. Credit markets faced heightened volatility, resulting in widening of spreads driven by write-off of Yes Bank AT1 bonds, imposition of lockdown, announcement of winding up of 6 debt schemes by Franklin Templeton, etc. However, the spreads normalized from Q2 FY21 onwards, supported by RBI's monetary and regulatory easing measures, recovery in economic activity, lower than expected impact of pandemic on financial institutions, improvement in collection efficiency of banks and NBFCs, etc. In recent developments, MPC in its meeting concluded on 7th April 2021 unanimously voted to keep the policy repo rate and reverse repo rate unchanged at 4% and 3.35% respectively. It also voted in favor of maintaining an accommodative stance as long as necessary to sustain growth on a durable basis and continue to mitigate the impact of COVID-19 on the economy while ensuring that inflation remains within the target going forward. In addition to the above, RBI also announced the following measures: setting up of Secondary Market G-Sec Acquisition Program or GSAP 1.0. Under this program, the RBI will commit upfront to a specific amount of open market purchases of government securities. For Q1 FY22, RBI has announced target of INR 1 lakh crore with first purchase of INR 25,000 crore to be conducted on 15th April 2021. To conduct longer tenure variable rate reverse repo operations to manage liquidity more efficiently. RBI also categorically mentioned that this is part of liquidity management and should not be viewed as a liquidity tightening measure. RBI announced special liquidity facility of INR 50,000 crore for select AIFIs for a period of 1 year for onward lending in FY22. Under this scheme, NABARD, SIDBI and NHB will be provided INR 25,000 crore, INR 15,000 crore and INR 10,000 crore respectively. On-tap TLTRO scheme for specific sectors, introduced in October 2020, was extended by 6 months till 30th September 2021. To recall, liquidity availed by banks under the scheme is to be deployed in corporate bonds, commercial paper, and non-convertible debentures issued by entities in these sectors. It can also be used to extend bank loans and advances to these sectors. Ways and means advances for states and union territories was increased to INR 47,010 crore from INR 32,225 crores. It simultaneously allowed extension of enhanced interim WMA limit of INR 51,560 crore for another 6 months till 30th September 2021. For our detailed note on monetary policy, request you to view our commentary published on 7th April 2021 and available on www.hdfcfund.com. Outlook. Over the past year or so, RBI has been ultra-accommodative and has proactively taken steps to cushion the impact of the COVID-19 pandemic on growth, which has kept yields low. In addition to a sharp reduction in policy rates, RBI took multiple conventional and unconventional measures to improve liquidity and maintain easy financing conditions. This was again demonstrated in recent announcement of GSAP 1.0, with upfront amount committed. While GSAP will be one of the additional tools to be used in overall liquidity management framework of RBI and will be used keeping in mind overall liquidity requirement, it was perceived positively by the market participants and resulted in yields at the longer end falling. Further, the RBI governor, in his overall dovish statement, repeated the commitment to maintain ample liquidity after meeting requirements of all financial market segments and productive sectors of the economy, and ensure orderly evolution of the yield curve, with the objective to eschew volatility in the GSEC market. All these measures and actions had a moderating impact on the yields and spreads. The situation is, however, changing over the past quarter. The overall environment has turned relatively adverse for GSEC yields, with rise in international crude prices, increase in 10-year US Treasury yields, significantly higher fiscal deficit as anticipated, elevated CPI, especially core CPI, higher domestic fuel prices increasing risk of second-round impact on CPI, etc. Consequently, the GSEC yields have risen approximately 20 basis points since end December 2020. In our view, these factors could continue to impact GSEC yields, at least in the near term. Further, high SLR holding of banks and signs of broad-based improvement in economic activity can also push yields higher. However, despite multiple adverse factors at play, the rise in yields have been lower than earlier anticipated, mainly due to continued RBI intervention by using conventional and unconventional tools. The past actions of RBI in the last 1 year or so, along with the guidance and measures announced by the MPC on 7th April 2021, suggests that RBI will continue to intervene going forward as well, and is likely to limit any sharp increase in GSEC yields. Again, a comfortable outlook on balance of payment, muted credit growth, low global rates, and ample liquidity bode well for yields in India. The recent rise in COVID-19 cases can also impact recovery in economic activity and can put downward pressure on yields. However, use of longer tenure VRRR can result in yields at the shorter end of the curve rising, and thus reducing term premia to a certain extent. In view of the above, we expect yields to trade with a slight upward bias, though the upside should be limited to a certain extent. However, there is a reasonable probability that the actual fiscal deficit for FY22 turns out to be lower than anticipated, either due to lower expenditure or better than expected tax collections, along with possibility of lower inflation from Q3 FY22 onwards. This may result in yields trending lower as against the view of gradual upside. Considering the above, we continue to recommend investment in short to medium duration debt funds if needed in a staggered manner in line with individual risk appetite. While credit environment still warrants caution, measures by RBI have eased the spreads on AAA rated bonds significantly. However, opportunities exist in select pockets of non-AAA rated bonds as their spreads relative to AAA rated bonds are still trading at attractive levels. Hence, allocation to credit-oriented schemes or funds with some non-AAA exposure can be maintained or increased in a phased manner in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.